Right, it's 2 minutes past. I think we can get going. Good evening, everybody, and thank you for joining this webinar on what is a pretty depressing day in Israel. I see that there's some names I recognize here from Israel and from all over the world. So welcome. But unfortunately, those of us sitting in Israel, it's not the greatest mood. So I'm going to be talking for about 30-40 minutes. I'm going to do a hard stop at 45 minutes. If I haven't answered all the questions then please feel free to drop us a note afterwards and I'll try to answer your questions. This is being recorded. It will be on our YouTube channel or on our website. You might get sent a link afterwards. And in the questions, I'm going to, in the registration process, you were asked if you wanted to ask a question. So I've got a bunch of those questions. I'll try to answer them as I go through the webinar and then at the end. And as I say, I'm going to do a hard stop at 45 minutes before I get too boring. Okay. Let's get going. Before I get into what's been happening in the market, I just want to express a sort of philosophical view, okay? Pioneer uses a top-down asset allocation approach. We didn't invent this. It's based on some academic theory. Those of you who've studied finance in any capacity, you would have done a mean variance optimization or a capital asset pricing model or a Markowitz, something or another. And basically what that says is for every given level of risk, there's an optimal theoretical portfolio. So Pioneer has taken this academic process and we've applied it our own assumptions. We're not the only firm that does that. Many firms around the world do that, but everyone has their own sort of take on it. Okay. This asset allocation process has a number of fundamental assumptions. Number one, you've fully diversified away single company risk. So you've got market risk. The second assumption is you're not trying to time the market. It's about time in the market, not timing of the market. You've heard that phrase probably. And that's because a huge percentage of the long-term positive performance of the market comes from a very small number of positive days. And if you miss those days, you're going to be very different from someone who was in the market all the time. So we got this volatility. We have to be in the market to enjoy that. And the third assumption is this fundamental negative correlation between stocks and bonds being your two main asset classes. Okay, so when stocks go down, there's fear, money goes to quality assets, which are historically bonds. And we've got this balancing act that gives us confidence as advisors. When an advisor sits opposite you and says, I can build your portfolio which meets your needs, you've heard that cliche. It's based on this fundamental correlation. Why do I bring that up? 2022, we're all still bruised from 2022. The market was very painful, and we've all experienced that in our own portfolios or professionally managed portfolios. And why is that? Because 2022 was the most difficult year on record for an asset allocation philosophy that we use. Right? Stocks and bonds had a very high positive correlation. Instead of the historic negative correlation where the one goes up and the other goes down, we had a strong positive correlation. We had interest rates going up very fast, which hurt the bond side, and we had a massive lack of confidence, which hurt the stock side. So stocks and bonds had similar results. And if you were in the ultimate expression of this asset allocation is the 60-40 portfolio, which you might have heard about. 60% equities, 40% bonds. And if you're in this simple asset allocation portfolio, then you would have experienced minus 18-19% in 2022, right? Pioneer portfolios did better than that, thankfully, but that was the simple portfolio. And a lot of commentators were saying that the 60-40 is dead, right? This long-term asset allocation philosophy is dead. And that was what was being said in 2020. We didn't believe it was dead, but it's natural to have some self-doubt and because of what was going on. So 2022 was very difficult for asset allocators like Pioneer. But 2023 has kind of reaffirmed or reconfirmed my faith in this asset allocation process. And there are a few reasons for that. One, interest rates are more stable. So I think the worst is behind us from the bond market point of view. At the beginning of this year, we had a very, very poor economic outlook, okay? We had high inflation, we had rapid new interest rates, and some political pressure, Ukraine war, lots of reasons not to be invested in risk assets. And had you taken that on board and sort of significantly changed your asset allocation, then you wouldn't have enjoyed the very positive results of 2023, which surprised many. And the resilience of the US economy has surprised many. And that can only come from using a sensible asset allocation. You need to be in the market and to enjoy those ups and downs. You can't possibly time the market. Another interesting point, which I just want everyone to remember, is that many times the market there'll be an announcement of some economic data, and the market might move. So say, for example, there's some economic data is released and the market goes down. And the financial press make the connection that the one caused the other. But the market went down because people are selling. Those sellers might have had a plan to sell regardless of that economic data. So too often we make this connection, or the media makes this connection, and that reinforces the belief that you can time the market, but it's not actually true. So just to conclude this little philosophical discussion before we jump into the markets, I don't know of a better approach than an asset allocation based approach. If there is, I'm willing to listen. I've done all the courses, I've done the academic background, but I really believe that this is the most sensible way to manage money going forward. The fact that 2022 is hanging over all of our heads should not mean that we should throw this baby out with the bathwater. Okay, let's dive into what's been going on in the markets. So here I have my usual table, but I've included a column on the right-hand side so there's year-to-date June 2023. You can see lots of green there. The last 36 months is just an arbitrary look back. It takes us to July 2020, so after the March 2020 Corona knock, and but also after a little bit of the rebound, okay? And then you can see in the last column, January to June 2022, just how bad 2022 was. Look how much red, and look at the size of those red numbers as well. So the first line there is the S&P 500, the bellwether for the US economy, plus 16.8% January to June. This is what I'm saying about if you would have taken the poor economic outlook in December, and you would have reduced your equities thinking there's a recession coming or whatever the case may be, then you would not have enjoyed these very strong positive returns in S&P and in NASDAQ. NASDAQ is a line item we hold in our model portfolios, and there was a lot of pressure to sell that, but we kept it, and we've enjoyed those plus 39% returns so far this year. The very important thing to remember when looking at that plus 16.8, I'll just move my mouse around there. There we go. So about 11% of the 16.8 is coming from 5 mega cap companies. They're names you know: Apple, Microsoft, Google, Facebook, and NVIDIA. NVIDIA is the chip maker who is enjoying this artificial intelligence boom. So I think when you look at that 16.8, you've got to separate it between these mega caps, which we can speculate why they went up so much, and the rest of the market. So think about it as sort of 6 or 7% general US market, and then 11% mega cap influence. The MSCI World is, it's I don't know, about 60% US stocks. And it just shows that the rest of the world is also positive, but not as positive as the USA. Tel Aviv 125 equity minus 2%. So we expect a higher correlation between US stocks and Israeli stocks. There's two reasons why Israel's so far behind. Israel, there's the political mess that I touched on in the beginning. For sure, that's impacting the market. And we also have new high interest rates. We have an economy that relies heavily on property. Property is heavily levered. And we have a general risk-off sentiment in the high-tech world. So these things all impact the Israeli economy. It's very subjective to say which is bigger. Is it the political or is it the economic pain? But the bottom line is that Tel Aviv stocks are quite far behind the US this year for those reasons. China, for those of you who've watched my previous webinars, you know that I'm a long-term bull in China. You can see here that it's minus 5%. This is the general index in June 22. And if you've been there the last 36 months, minus 27%. Now, the fundamentals of China are still strong. The economy is strong. They're the fourth largest exporter of oil. There's so many strong good news things. So why has the stock market in China not delivered? And I think it's all about political risk. Nobody trusts the Chinese government to let those profits flow through to shareholders. And it's going to be a while. It's going to be a while before that confidence comes back. So it's political risk that's hurt us there, which of course is very difficult to predict. But the fundamentals of China are strong. Don't write China off. Okay, the next line item there are global bonds. And this is the real pain for most investors, right? This is, if you were in that simple 60-40 portfolio, then you would have been holding an ETF that tracks this global bond index called the AGG, Aggregate Bond Index. And year-to-date 2023, 1.4%. So if you annualize that, let's say it's like 3%. We're currently expecting from bonds a lot more, closer to 6% from our bonds, right? So this is kind of showing that negative correlation, the return of that negative correlation that we actually need. So stocks are up, bonds are a little bit down, so that you can see that negative correlation working a little bit there. But the real pain is holding those bonds. Look back over 3 years. 3 years of holding these investment grade bonds, and you are minus 14%. That of which 13.9 was in 2022. Now, this is impacting every single investor around the world. There's almost no investors who were professionally managed who had zero bond risk. If you had less bonds, or if you had shorter bonds, then your damage was less. But this is what's going to keep investors a little bit disappointed when they look at their portfolio. It doesn't actually matter who was managing your money, whether it was Pioneer or Goldman Sachs or JP Morgan. Everybody suffered in that space. And it's going to be with us for a while until until those coupons catch up and we can put that behind us. So that's probably the most significant thing. Treasury bonds is a similar story. Gold, as you've probably heard from me in the past, say that I'm not a big believer in gold. You get a lot of volatility and very little predictability in gold. So for the same risk, if you would allocate it to equities, you'd be much better off. I don't think gold would have protected you from inflation, which is what the common understanding. Israeli corporate bonds this year are positive more than the global bonds, plus 2%. And the long-term story on Israeli bonds is a little bit better than, or quite a lot better than the global story. And that is because most of Israeli corporate bonds are inflation linked. So the main bond index, the Tel Bond 60, in shekels, 6.8% for 36 months. Not a great result, but certainly a hell of a lot better than minus 14. And that's because of the inflation linkage of these Israeli corporate bonds, which they don't really have in the global market. Hedge funds continue to disappoint in general. There are some names which are, if you have some high conviction view, you can try to pick a winner. in the hedge fund space, but in general, across a diversified portfolio of hedge funds, there's some serious question marks about hedge funds. Okay, that's broad level index performance year to date and longer term perspective. Okay, here is a graph which shows the S&P, and I put this in because I want to show you where we are relative to where we've come over the last few years. I think it's interesting. So on the left-hand side, we've got pre-corona, this little bit at the end of 2018. I don't know if those who remember, we had some Trump-China disaster, then the Fed pivot, etc., those type of things. And we were cruising along, and then along came corona. And this big sell-off here in March and a pretty quick recovery, heavy fiscal support by governments around the world, literally printing money, for lack of a better word. And the market did very, very well. Then came the Ukraine war, inflation, sticky inflation, and we gave back. This is 2022. Yeah, that gave a lot back. Not a straight line, some volatility along the way. So it could have actually been worse for those investors trying to time that. But we gave a lot of that back, and then some recovery, and now we're back at approximately 4,400 level for the S&P. So we're still about 5-8% off the top. And the interesting bit here is how far we've come since pre-corona. So you may say to yourself, okay, wow, look at this big jump from pre-corona to where we are today. And I would say a large chunk of that is actually justified, because the fiscal support that governments gave economies around the world filtered through to corporate profits at the S&P level. So part of that jump is justified. How much? I don't know exactly, but we shouldn't be too concerned about where we are today relative to pre-corona. But I just think that this graph is kind of interesting. Okay, I'm now going to give you a little bit of snapshot, mixed bag sort of economic view. I'm not an economist, but I think that some of these points are interesting. I attended a conference by the head of wealth management of Goldman Sachs the other day, and he was talking about navigating through the fog and how difficult the macro environment is to read. So if Goldman Sachs with all their resources can't read the macro environment, I submit to you that your humble asset managers in Herzliya Pituach also may not know how to read the situation. But again, I'm an asset allocator, so I don't pay too much attention to trying to read the situation. The markets were expecting a recession. As I say, the outlook was pretty poor. We've been positively surprised by the resilience of the American economy, and there hasn't yet been a recession. We think that there's a recession in process in Europe now, but it's certainly not a terrible one. And if you go there for your summer holiday, you will see that Europe is pumping. So there's certainly no major signs of a terrible recession. But yeah, in time, we might see some formal data to say that Europe is in a recession. And the irony for me is that the interest rate rises, which started in the United States, are hurting Europe more than the United States currently. The biggest issue for me, looking back at the 6 months of 2023, is this banking crisis, in inverted commas, which was avoided, or at least shrugged off by the market. Anyone who's been managing money through 2008 has some post-traumatic stress from when you hear the phrase banking crisis or banks going under. Anyone who was around in 2008 sits up and goes, oh my God, that could be terrible. So March started with Silicon Valley Bank, and account holders never lost money. Bondholders, senior bondholders never lost any money. Equity holders obviously lost money, but that was the first bank. And then came Credit Suisse, the second largest bank in Switzerland. Switzerland is supposed to be this island of stability and safety. And if a brand name like Credit Suisse can go under, then, oh my gosh, any bank can go under. So, but Credit Suisse has had 5 years of poor management and one crisis after another. There are reasons why, but the market turned around and said, no, banks are actually strong. Their balance sheets are strong. Their profitability is strong. And Credit Suisse, whether it's Credit Suisse or Silicon Valley Bank or Republican Bank, these are all isolated and unrelated, and there's no systemic risk in that. I breathed a huge sigh of relief. This was a much more powerful signal to me. At the time of Credit Suisse, I was considering pushing a panic button, but it didn't happen because very quickly the Swiss regulator ensured that it was only the additional tier 1 bondholders who got hurt, really, and it was fine. So what started off as a big red flag, it actually turned out to be a source of comfort that the banking sector is strong and the profitability is strong. And the analysts that I follow in the banking sector have all said that the bank's balance sheets are really, really, really strong. If you held banking shares this year, you probably didn't make money because the sector was hurt by the fear, but at least it wasn't a systemic risk. And we should take comfort from that, not be panicked by it. We should take comfort from it because the world is much, much stronger than it was in 2008. Inflation. I'm going to do a slide specifically about inflation in a second, but inflation is coming down. It's a slow process, and it's going to take more time. The Fed paused interest rate increases in June. July is debatable. We're not sure. It depends where that inflation number is going to come. I personally don't think there'll be another 0.25 increase by the Fed in July, but it could happen. If it does happen, I don't think it'll be a major train smash, and the market should ride it through. I don't want to. If by the end of the year inflation hasn't come down below 4% by the end of the year, then things could get a little bit hairy. I think that the probability of rates coming down in 2023 is close to zero. The Fed have said very, very clearly they want to see inflation under control before they reduce rates. It's taking longer than everyone thought, and it's not going to happen this year. So those of you who think that interest rates are coming down soon, I beg to differ. Watch out for leveraged investments. So your typical property investment has some leverage in it. We're doing everything we can to keep an eye on the investments that we have. Don't be surprised if the manager there holds back on his cash distributions while he builds up a cash buffer, because that's the right thing for a manager to do. So don't be too surprised in that regard if that happens. Okay, recession. So I think the reasons for a recession are quite obvious to everybody. We've had a big shooting up of interest rates. We've had a big risk-off sentiment. And people have been expecting a recession for quite some time. But let's look at some of the reasons why the economy is more resilient, okay? The US economy is fundamentally strong. It's a consumer-driven economy. The consumers are wealthy. They have access to debt if they want. They spend, and and it's strong. It's a strong democracy, despite its leadership, it's fundamentally strong. Interestingly, there is low, or I should say, not high or excessive amounts of private sector debt. So compared to 2008, there was much more private sector debt relatively. There hasn't been a wage inflation spiraling. Real wages have actually come down. The labor market is very, very tight. In fact, unemployment came down in 2023, which is very strange if you're thinking that there's going to be a recession. There's still lots of fiscal spending going on. The Biden administration announced a climate change bill. There's lots of military spending going on. And that's all contributing to a strong economy. Then there's the whole AI, artificial intelligence boom, which is happening. A lot's been spoken about it. I don't want to get too much into it. So a lot of it is artificial, and some of it is intelligence, but there certainly is a mini bubble being created around this AI story. If you look at NVIDIA, which is probably the main winner, which is a very large chip maker, it's trading at extremely high multiples. So they have to deliver a lot of growth to justify their current level of share price. Very tight labor market. Here's an interesting point. Post-Corona, during Corona, companies laid off lots of staff. And then post-Corona, they struggled to hire that staff back. And they struggled to train them. They struggled to find stability in their staff. There was a lot of bruised management around post-COVID rehiring. Now, with the threat of a little bit of a recession or slowdown or whatever, a lot of firms are not laying off workers as quickly as they would have pre-Corona, because they've learned just how hard it is to hire those people back. All of these things together add to the resilience of the US economy, and we should draw some optimism from that it's not the end of the world just because interest rates are a little bit high, very high. Here's some inflation data for you. So the United States, inflation peaked in June 2022 at a headline number of 9.1, which is extremely high. Okay, and most of that was coming from services, which is linked to the tight labor market, and energy prices, which is linked to the Ukraine story. The latest number is 4.9, so it's come down quite a lot. The biggest contributor is still services. The expectation, ours and Goldman Sachs and a few others that we rely on, that we follow, is that 3.5% by year end. If that happens, then we're on track. If it's higher than that, that's worse, because that means inflation is even stickier than we think. The Fed want inflation down 2 to 2.5%, or trending in that direction. They haven't set a date by when they want it, but they want to see inflation coming down to those numbers. So we've still got a way to go before interest rates come down. Europe is a bit more extreme. Inflation peaked later than the US in October at 10.6. Mostly from food and energy. You remember the stories about a cold winter or UK energy prices shooting through the roof. So that was the drivers of inflation then. Then by April, it's at 7%, mainly from food and services. And the expectation for European inflation by the end of the year is 4%. Conclusion: be patient. This is going to take time. Okay, let's have a look at the remainder of 2023. I do think that there is some economic pain, but overall, I think that a lot of it's priced in, a lot of it's anticipated. There are going to be some high-profile problems, okay, in the press. There are some over-levered companies. Some of those companies are household brand names. And don't be surprised if you hear of a bankruptcy or a restructuring or something like that along the lines. I don't expect it to be in the banking sector, but there are some, especially the property sector, you might see some restructurings and some drama. As I said, a lot of alternative funds. There's a big liquidity issue happening right now. A lot of investors are trying to get out of these funds, and the underlying assets are illiquid, so we might see some funds gate. At Pioneer, we're in some alternative funds. We're trying to keep as best an eye on what's going on inside some of these funds. A lot of them, we can't do anything because we don't have full flexibility, but others, if we have a problem, we will instruct to exit if we can. Don't fight the Fed. You've heard that phrase before. So as I said, no reduction in rates is expected for 2023. We need to I'm looking at the second half of 2024 before rates start coming down. What does that mean for our portfolio positioning? We like high quality corporate bonds. High quality is investment grade. We're willing to go a little bit longer on duration now than we were a year ago. So a year ago, we were buying high quality bonds with a 2-year sort of outlook, 2, maybe 3-year duration. Now we're looking at sort of 4 and 5-year duration on single name bonds and in the investment grade space. I think that we have some interest rate stability that we can rely on. We have an overweight position on cash, both in our shekel portfolios and our dollar portfolios. For us to hold about 10% cash in a money market fund, we're getting nice interest on that, but that's quite a lot of cash for us. We're underweight emerging markets and other non-USA stocks. We're underweight Japan and we're underweight Europe compared to the MSCI index. I remain a big fan of structured notes, not for every investor, but certainly if you can get 10 or 11% on a sensible structured note, then that's something you should be doing. Okay. These are the questions we received on registration. I've merged a few of them together because a lot of them covered the same topics. So this, hopefully everyone can benefit from each other's questions. How does the political events may affect the shekel dollar currency and the Israeli economy? Okay. Interest rates are rising in the US. Does that indicate a fall in the dollar shekel rates as rate increases have been paused by Israel? Okay, so basically this question is asking about the Israeli economy and the dollar shekel. Predicting currencies is a very, very, very difficult thing to do. Fundamentally, I believe in a stronger Israeli shekel. So I think when things calm down, please God they will, when things calm down, then we'll see the shekel trend stronger, I think. Not all the way down to 308 to the dollar that we saw previously, but certainly a little bit stronger than the current 3.7 or high 3.6s. So I do think that the shekel will strengthen in time. And we'd like to see the reestablishment of the negative correlation between the shekel and the S&P 500. Historically, when the S&P 500 went down, the shekel weakened, and when the S&P 500 went up, the shekel strengthened historically. Things of this year, because of the political crisis in Israel, things are happening a little bit different. But historically, that was quite a reliable correlation. So the political events in Israel, for sure, it's hard to imagine anything positive coming out of this current crisis that we're in. We do hope that it's resolved sooner rather than later, but it is affecting. It is affecting risk sentiment. It is affecting the high-tech industry. It is affecting new government expenditure. It is affecting the economy. It's difficult to say that it's not. And it will be harder to predict the shekel. I think from a financial planning point of view, if you are listening to this call, you might be a Oleh Hadash or a new immigrant to Israel, and if you are the typical Oleh Hadash, then you are overweight dollars in your portfolio because you're holding on to the 10-year tax-free scheme. The rate today is a rate that we would have dreamed about 18 months ago. So it's a good rate to move dollars to shekels from a financial planning point of view and not from a tactical point of view. Here is a slightly technical question. The question says that when there is an inverted yield curve, historically a recession follows, okay? The yield curve, just to remind, is a graph where the x-axis is the maturity of US government bonds, and the y-axis is how much you're going to earn. Right now, on shorter bonds, we earn about 5-point-something%, and on longer bonds, like your 30-year bonds, you're earning 3-point-something. So we have an inverted yield curve, okay, which is abnormal. And normally and logically, you would be rewarded more for longer-term investing. Now it's the opposite. So either the long-term rates are going to come up or short-term rates are going to come down as that is reestablished. And this question is says that there's some data that this yield curve is a predictor of a recession. Yes, it's true. It is a predictor of recession. It's not 100% accurate, but it is a predictor. So it's more of it's not a driver of a recession, but it is a sign that short-term rates are high and unnaturally high, and that's going to have an impact, and that could create a recession. So it's not the yield curve causes the recession; it's higher short-term rates that cause the recession. So my thoughts are that at the beginning of the year, I thought that a recession was guaranteed. I thought it was 100%. I listened to Goldman Sachs. They said it was 65% chance of recession at the beginning of the year. They're now saying 50% chance of recession. Other firms that I follow are a bit more optimistic. They're saying that if there is a recession at all, it's going to be very shallow and very mild. So I don't believe we're going to have a severe recession. We are experiencing a growth slowdown, but it's not terrible. And if we do have a recession, it's certainly a very light recession. So even though the yield curve is extremely steep, I don't think it is something to be overly concerned about. Question is, how long can we remain with this very abnormal yield curve? It's a good question. I'm not sure what the answer is. The next question is similar to that. So I would say it's very difficult to predict. As I said, Goldman Sachs says a 50% chance. I think higher than that, but not a bad recession. And I think from an investor point of view, a shallow recession or a growth slowdown is probably the same thing. It's not that we should worry terribly. Since World War II, I think there's been maybe 10 recessions or 10 or 12 recessions. So it's not something new. It's not something we should be too panicked about. It's natural to have periods of growth and slowdown and growth and slowdown. So don't be too concerned about the recession. Next question, when will the stock market decline end? Well, I think it ended in 2022. As I showed you, most of the stocks are up this year, except in Israel. And the return to normality, wow. I don't know what normal is. I've been in this business since 1999, and I've been managing money since 2006, and I'm yet to comfortably say we're in a normal anything. So I don't know what normal is. We have to plod on. We have to stick to our philosophy that I presented in the beginning, which is that asset allocation philosophy, which works most of the time. Okay, and in the longer term, I believe it will work. My forecast for 2022, 3 and 24. I assume you're talking about performance forecast, not economic, because I've touched on the economic stuff. I would say the bond side of the portfolio is going to be relatively stable, and the equity side is extremely difficult to predict. I'm not anticipating a crisis. My gut feel is that the worst is behind us for this current inflation crisis, unless inflation remains very, very sticky. So I think the bond component will deliver the returns that we're expecting, and the equity side, well, one needs to take a long-term view. BRICS and Co. Okay, this question is clearly from a South African. So I don't know if you know, but the BRICS, so that's Brazil, Russia, India, China, are trying to find an alternative to the US dollar. And a bunch of other countries have joined them. Do I think that this is going to happen or be a major threat to the US dollar? And the answer is no, I don't. Firstly, these BRICS, no one trusts each other. No one has anywhere near the confidence in any of those countries that they do in the USD. And if they did create anything, then the Americans would probably shoot it down one way or another. But this is not something that's even on my radar. So I don't worry about that. The next question, there's two questions which I joined together. So small retired investors do when their balance has to last the rest of their lives. Financial planning question. Or where should a medium risk shekel-based portfolios be invested at the moment? Well, it's quite simple. Corporate bonds are back. Bonds are back. We're now able to get returns that we expect long term on the bond market. For many years, we were struggling to produce returns out of bonds. Bonds were giving us 1%. Now the equivalent bond is giving us 5%. We had to suffer the transition of 2022 to get to this point. If you were not invested, then you were lucky. If you invested, then you suffered a little bit, but at least now from an income point of view, you can earn more on your capital than you could prior to the 2022 shooting up of interest rates. So I think from a retiree point of view, it's good news going forward. I don't think interest rates are going to go down to 0 or 1% as they were before. I really don't. So even if they come down a little bit, they're not going to go all the way down to that level. Do I see a general recovery in Israel's high-tech industry in the second half of 2023? The answer is no, I don't. It's going to take a while for the risk sentiment to come back. There'll still be deals to be done. And the existing big companies that operate in Israel, they're fine. Whether it's Microsoft or Intel or SAP, those big companies are okay. They've got very strong businesses. The startups, high tech, well, some risk off sentiment there, but that's healthy. I think some of the valuations that these companies were asking for were ridiculous. And so now it's a bit more sensible, but it's going to take time. It's going to take time. Is Pioneer taking advantage of the current relatively high interest rates on liquid assets? The answer is yes, absolutely. We're enjoying these high interest rates on high quality bonds. The money that's not invested is sitting in money market funds that is giving us a decent return. So yes, we are taking advantage. How different are short-term portfolios from long-term? Well, typically short-term portfolios, you want more predictability. So you're going to have shorter, you're going to have more money in bonds and shorter bonds. And then you have, your return is more predictable. Whereas long-term, you're willing to typically have a higher equity percentage, and you're willing to live with the volatility that comes from that equity allocation because you want a higher return over the long term, and you're not that time sensitive. So that's the basic difference between those two. Also, there's liquidity. A long-term investor can be invested in something that's illiquid, whereas a short-term investor cannot. Why are there no options for interest earning cash money market accounts in Israel? Well, I suggest, whoever wrote that question, I suggest you speak to your financial planner or your banker or both. Absolutely, there are options for interest earning vehicles on cash in Israel. Okay, so that wraps up the questions received on registration. Let's just have a look at the questions received now. I got a question about a particular company here. I'm not going to mention the name. I don't know that particular company, so I'm not going to comment. But the question is about commercial property space. Am I concerned about commercial property? And the answer is kinda. It depends what. There are good companies that will absolutely be fine, and there are some over-levered companies, and there's going to be some restructurings there. If you're in a particular deal, each deal you need to be looked at on its merits. I think that in commercial property space, there was a view that Corona is going to kill office space and everyone's going to work from home. That's not entirely true. There's some resilience to going back full time, and a lot of companies are 4 days a week or 3 days a week, and a lot of people who live far from their offices are not going in all the time. But that's, so I don't think that that's a fundamental issue. The main issue with commercial property is the leverage and the high cost of that leverage. So that's that. Okay, if there are no more new questions, let me just see if anything came through on the chat. No. So that's exactly 45 minutes. And I've answered the questions I wanted to answer. I hope you enjoyed this call. Please feel free to drop me a note with any other comments or calls or feedback or complaints or whatever the case may be. And I do pray for a speedy and broad consensus resolution to this current challenge we're facing in Israel. It's deeply depressing, and I do hope that it is resolved sooner rather than later. And that's all. Thank you all for your time. I hope you enjoyed this webinar.